Let's talk today about retirement investing, including job sponsored and job linked accounts. So, let's talk about employer sponsored retirement plans. These are accounts where employees can buy stocks and bonds, mutual funds, etc., through an employer connected account, sometimes with tax advantages, sometimes with matching from your employer. Now, we've talked about retirement accounts like a Roth IRA or a traditional IRA. These you do yourself, these are not connected to your employer. Um, these are different types of accounts which run through your job. So let's talk about the most common ones today. We'll compare them. They boil down to 401k, Roth 401k, simple IRA, SEP IRA. All right, so let's get right into it. So, first type of account that is important to understand is a 401k. 401k. We are also talking here about a 403b. Not exactly the same, but they function very similarly. 403b is for nonprofits and educational institutions. And then there's also a 457 plan, which is usually for state and local government employees. Tiny differences for our purposes. This is one category. With all of these, what you as an employee can do is set aside a certain amount of money per paycheck to go into a 401k account. And these are tax deferred, or what are called pre-tax dollars. Okay. So pre-tax, in our common example, if you have a $50,000 salary and you contribute $5,000, you pay tax as if you had only earned $45,000. The taxes are paid when you withdraw the money from the account, both contributions and earnings, ideally in your retirement. So we will put pay taxes on withdrawal at the point at which you want to use that money. Now, one of the nice things at many places about 401ks is that there is employer matching. And typically the way that it is done is there is a match up to a certain percent. So we will put example, a 3% match. The way this works is if you contribute 1% of your salary, the employer matches 1%. If you contribute 2%, employer matches 2%. It maxes at 3. So if you contribute 3%, they contribute 3. If you decide to contribute 5%, the employer still contributes only 3%. This is essentially what we call free money. Now, I know nothing is free, and the employer has calculated, well, I'll offer this instead of a higher salary. Okay, given your salary, taking a match is essentially free money. There's also a limit to how much you can put in per year because of the tax benefits. So the max for 22 was $20,500. The max for 23 is going to be $22,500. So you can't contribute more than that. It's a bit higher if you're over 50 and you're catching up. The other limit is that your employee plus the total employer contributions are limited to, so we'll say total limit is 100% of compensation, or in this case, it's an or, it's $66,000 for 2023. Okay. So your contribution plus your employers can't exceed $66,000 in 2023, no matter how much you made, no matter what the match is. Okay. Aside from specific exceptions, you have to be 59.5 years old before withdrawing, or you would get a 10% early distribution penalty. And then there are what are called RMDs starting at age 72. RMD stands for required minimum distribution. You have to start taking money out at that point in time. Okay. Let's now talk briefly about a Roth 401k or equivalent 403b, etc. We're going to put them together. These are less common. Roth 401k, and we will say, etc. Just like in a Roth IRA, the difference with Roth 401k contributions is that these are after tax contributions. Okay. You did contributing 5,000 today does not lower your taxable income. There is no tax deduction when you contribute. But when you take the money out in retirement, then you don't pay taxes. Okay. So we might call that use money tax-free. And I know my handwriting is atrocious. Hopefully, I'm still communicating valuable information. Okay. The matching works a little bit differently on the Roth 401ks. Employers can match Roth 401k contributions, but they go into a separate sub-account. And the employer part of the contribution is pre-tax. Okay. Otherwise, this is basically similar to a 401k, 59.5 to make qualified withdrawals without a penalty. It has to occur at least 5 years after the tax year in which you first made a Roth 401k contribution. And financial advisors will typically tell you, you should work on taking the maximum match as quickly as you can because that's free money that you only get to contribute. You only get if you contribute. Later down the road, your view might be a little bit different depending on your situation. You probably won't have a choice in terms of which kind is offered. Typically, employers either have a 401k or a Roth 401k. It's not like you get to choose, oh, well, give me the Roth 401k. It's one or the other. There might be some situations where you have a choice between the two. Let's now go and talk about the simple IRA. Now, remember, Roth IRA and traditional IRA are personal types of retirement accounts. Simple IRA, even though it is called an IRA, is an employer-based account. Simple IRA, common in small businesses, common among self-employed. Just like a 401k, these are tax, again, you can call it tax deferred or deductible contributions. They lower your taxable income. The employer must either make matching contributions or non-elective contributions. So there's two options, matching or non-elective, okay? So this means employers can set this up one of two ways. They can say match up to 3%, and then it's just based on what you contribute, or like a 2% flat match where you get this whether or not, oh, I'm sorry, it wouldn't be a match then, that's confusing, a 2% flat contribution. So an employer might say, we don't care how much you contribute a lot or not a lot, we're just giving everybody 2% of their salary right into this account. Limits are a little bit lower. So the limit was $14,000 in 2022, and it will be $15,500 for 2023. You can catch up and do a little more if you're over 50, 59.5 for withdrawals. All the other same stuff exists. Okay. So now let's talk about the SEP IRA. I used to actually have a SEP IRA at one point. SEP IRA, this is the last one that we're going to talk about today. SEP IRA. A SEP plan is also for small businesses. It also lets employers contribute to traditional IRAs that are set up for employees. It also can be used if you're self-employed. Contributions are tax deferred. So tax deferred contributions. Okay. The big difference is employees don't make their own contributions. Okay. So no employee contributions. The contributions are made at the employer level, and it must be done same percentage for all employees. Okay. So if you imagine a business where you have someone earning 30,000 and 40,000 and 50,000, you might say we are doing 3%. And so this person gets $900 and this person gets, what is that? 900. wait, no, 3%, 3,000. Yeah, 900. Okay, you get the point. Anyway, I'm not doing the math right now, but that 1,500. Okay, why am I struggling here? 3%, 1% would be, no, I'm not even, these aren't even the right numbers. Okay. Anyway, the point, you all get it. My mind is a blank on the math. The employer makes all the contributions. This is also flexible for the employer because you don't have to make a contribution every single year for themselves or for employees. You might say, this year I'm doing 3%. Great. Next year you can't afford it. You don't make any contribution. Contributions are limited to 25% maximum of annual pay, up to a total contribution, same numbers, $66K in 2023, absolute maximum. Same rule applies for withdrawals, and there is no catch-up contribution. For the most part, you don't really have to decide between these things because if you're an employee, the employer decides. And if you're an employer, it's usually pretty clear which one makes the most sense. Always, of course, consult with financial advisor, tax professional, lawyer as needed.